Good evening, everybody, and welcome to our Wednesday night webinar. We are very excited to be with you this evening and to be introducing a new sponsor, Feldman Equities. This is an exciting webinar for us. I'm sure that you are going to see why when we hand over to the team. So thank you to everyone. We have got Larry Feldman and Chris Ross online with us this evening from Feldman Equities, as well as Scott and Lyndon from Team Wealth Migrate. So as normal, there is a question box and a chat box on your screen. Please could we ask you to pop in there, let us know where you're joining us from. We've got people that are joining from all over the world, and it's always nice for us to see that you know where to put your questions as we go along the webinar, and also just to see where you're joining us from. We will have a Q&A towards the end of the webinar, so please do type your questions in and send them through in the boxes, and I'll make sure that our panelists get to them and answer them. With that, I'd like to hand over to Lyndon and welcome the team.
Yeah, thanks everyone. It's good to see. I see as everyone keeps dropping in. Zoom always takes a while to let people into the rooms. So as people start dropping in, it's good to see a lot of our investors again, see your names pop up. We are all looking forward to the time when we can start having breakfasts and lunches again in all parts of the world and meet you face to face. But it's always good to see you online with us on Zoom. As you know, whenever we introduce a new sponsor, we really want to make it about the sponsor. So we try and talk as little as possible, which is why I'm talking first and not Scott. I hope you'll notice that. we get me to do the introductions as brief as possible. We first became aware of Feldman Equities about 18 months ago. As many of you know, we watch what happens in the US a lot in this space. We pay a lot of attention to partner platforms like CrowdStreet, and we first really became aware of Feldman Equities on CrowdStreet, and we reached out to them about 18 months ago, and it's been a while. We've had email conversations, we started talking on Zoom, and we're really excited that after this long courtship period, if I could call it that, we are now entering into a relationship. You know, Scott always says that Wealth Migrate's not very good at dating, but we are very good at marriage. And I think I'm hoping that this will be the beginning of a really great relationship and partnership with Feldman Equities and our investors. You know, I think for most of you, we often talk about a trophy asset, but you have likely heard us at Wealth Migrate speak about a trophy sponsor. And I think for us, that is almost more important than the asset and whether the asset is a trophy asset. And you know, we look for a range of very important things in our sponsors. And I'm going to give you the top 5 very quickly. Firstly, they have to be major players in their geographical region. They have to be niche specialists in the area of real estate that they are passionate and have experience and skill in. They have to have skin in the game. So we will not invest or allow investors through our system to invest if we're investing in partners who themselves don't have skin in the game. They need to understand and really be passionate about capital protection, just like we are on behalf of our investors. We take looking after your money very seriously, and we expect the same from our partners. And then the last one is we're looking for something different, something where there's something about the partner that makes us excited. And with, you know, Larry, as I hand over to you in about 30 seconds, something I saw that you stated in the media recently really made me aware that this is exactly the kind of partnership we are looking for. And I'm going to quote you here, Larry, from a recent media article. You said, "My MO has always been when we go into a recession, we have to outdo our competitors and take market share. With everybody in panic mode, this is our chance to take market share." A lot of people go into apathy in a situation like this. And that's the edge that we look for. That's something different, someone who understands and is confident and comfortable in their business and how they operate, to be able to add that something different that just gives our investors something extra. So with that, Larry, I'd really like to say thank you for joining us. Welcome to you and your team. We're very excited about this relationship. We look forward to many years with you and our investors. And with that, I'm going to hand it over to you to really introduce us to your team and to tell us a little bit about Feldman Equities.
Terrific. Thanks very much, Lyndon. My name is Larry Feldman, and my company's name is Feldman Equities. We are the largest privately held owner of office buildings in the Tampa Bay area of Florida. Tampa Bay is located on the west coast of Florida. We specialize in acquiring older buildings that are very well located. And we buy these buildings with the view of transforming every building with a multi-million-dollar renovation. Some of our renovations go upwards of $10 million or more to transform the building into a true Class A building. Our renovations change almost every part of the building, and they include completely new lobbies, new bathrooms, extensive renovations to the common areas of the building, including garage renovations, entirely new elevator systems, and new energy efficient air conditioning and lighting systems. One of the key trends which we established in the Tampa Bay market is the inclusion of multiple tenant amenities. Our amenities include high-end fitness centers, 24/7 chill zones, what we call chill zones. These are places where millennials love to hang out on soft seating, and healthy restaurants, just to name a few of our amenities. Let's go through, this is just a brief slide on our track record and our history. The emphasis on this track record that you see on this slide is with respect to our Tampa Bay properties. Every Tampa Bay property we've acquired, which is all of our acquisitions over the last 10 years, are listed on this chart. And there's more information on feldmanequities.com if you'd like to get more information on our track record. So let's talk about today's agenda and what we're going to cover. First, I'm going to talk about the potential impacts of COVID-19 and the future of office space. We're also going to give an outlook, not just for the whole office space market. We're going to talk about the macro US market, but we're also going to talk about specifics of Florida and Tampa Bay and how those office markets are reacting to COVID. And then we're going to drill down to a sub-market within Tampa Bay called downtown St. Petersburg. And finally, we're going to talk about an investment in a particular building we own, which is called First Central Tower. I'm going to provide information about that. And Chris Ross, our VP of Finance, will actually get into the financial information on that property. So I know a lot of you probably have questions about how we as an office building owner are dealing with COVID-19. Because of the large number of creditworthy tenants in our building and throughout our portfolio, we're well positioned to weather COVID. As of the most recent reporting period ending July 31, we've collected nearly 96% of all tenant rents across our entire portfolio. Many of you have read articles about how, going forward, everybody is going to be working from home and that there will no longer be a need for office space. Ironically, for almost every story about a company allowing its employees to work from home, there's another contradictory article. For example, Google's Eric Schmidt believes that office space demand is actually going to grow as companies will need to spread workers out throughout the office to provide more social distancing. The reality is somewhere probably in between these two extremes. Although some employees may permanently work from home, most employees will return to the office for at least some portion of the week. When these employees return to work, they'll occupy much more office space per capita in order to maintain social distancing. Following the 2008 recession, employers discovered that they could do what I call the sardinization of America. That is, what they were trying to do is pack more and more people into less and less office space. in order to cut down on the cost of rent. By putting more and more people into less and less office space, they figured they could actually save rent. And the fancy term, although I call it the sardinization of America, the fancy term is densification. We think that post-COVID, or during COVID and beyond, the new buzzword is going to be undensification. A recent survey by Gartner Inc. found that employees plan to keep only about 5 to 10% of their employees working exclusively from home. That's 5 or 10% working permanently from home. Backing that up, Gensler, one of the largest architects in the US, surveyed over 2,300 full-time US workers and found out that only about 12% would actually work from home exclusively. About 88% wanted to return to the office. Workers seem to understand intuitively what one Stanford study determined, which is that employees that remain at home rarely get promoted, and by the way, they rarely get a pay raise, or they certainly underperform the pay raises of their fellow workers that attend the real office. One of the best indicators right now for office space demand is the pace of leasing right now during the height of COVID fears. I'm happy to report that we have nearly 39,000 square feet of new leasing activity pending across the portfolio. We've just signed about 25,000 square feet. And we're also happy to see that a neighboring building near the investment that we're going to talk about shortly just signed a new 37,000 square foot lease right in the middle of COVID. Okay, so here is a very important article that just appeared in the Wall Street Journal, and the headline says it all. According to this article, employers are reporting that when employees work from home, projects are taking longer, training is tougher, and hiring and integrating new employees is more complicated. Employers report that workers appear less connected, and they fear that younger professionals aren't developing at the same rate that they would in real offices, sitting next to colleagues and absorbing how to do their jobs. Recently, I myself was quarantined for months in my own home. Even some of my closest friends didn't want to come see me or my wife. It didn't take long before I started to feel like Tom Hanks in that movie Castaway. In case you didn't see the movie, the character played by Tom Hanks was shipwrecked on a deserted island. Tom Hanks had all the food and shelter he needed, but due to his total isolation from people, he began to lose his mind. And that started to actually happen to me in isolation. During my quarantine, there were times where I felt like screaming, "Wilson, Wilson." In case you didn't see the movie, that's the slide of Tom Hanks from the movie. The reason I'm talking about this movie Castaway is I think it's very instructive about the future of office space. The point is that you can't go very long without people, without socialization. So I think that once the virus abates, employees will want to return to the office. An interesting analogy between the future of office space is the current situation with respect to universities and schools. My son, Mac, is in the process of completing his master's in real estate. While he was at the university having a true social situation, COVID began and he had to go completely virtual. His feeling is that as a result of going virtual and disconnecting from the physical proximity to classmates and interaction and networking, that he feels like the whole college experience has changed for the worse. And he feels like he's been cheated from the experience that he had before. So with the large influx of millennials into the workplace, you may have heard millennials now have surpassed baby boomers as the largest single population group in the United States. It's critical for these young workers to be mentored by older and more experienced coworkers, guys like me. This can only happen through face-to-face communication. We've been in the midst also of a loneliness epidemic in the United States long before COVID hit. It has real health impacts. In fact, loneliness has actually been tied to the equivalent of smoking 15 cigarettes a day in terms of its health impacts. Isolating office workers in their homes away from coworkers will only exacerbate the loneliness problem in America. So we know that most workers will want to return to the office, but the question is, how do we get them to return? Even if they're legally allowed to come back, how do we make the office feel safer? So to that end, we've implemented a range of different measures at our properties, both high-tech and low-tech. Now, the low-tech are some of the things you heard about, such as we're limiting capacity in our elevators to no more than 2 people. We're putting markers in the lobby of the buildings to encourage social distancing. We're requiring masks in all common areas of the building, and we even hand them out to everybody for free, just in case they forget their mask. But what's interesting is what we're doing on the high-tech side. On the high-tech side, we're looking at a host of systems that can help mitigate the virus and give our tenants the security they need to feel safe at the office. One system ionizes the air, providing a positive and negative charge that kills COVID. This is actually very similar to a thunderstorm. If you've ever smelled the air just after a big thunderstorm, that's actually the cleansing of microbes and particles and pollutants that are in the air that takes place through ionization. So we're actually in the process now of installing ionization systems that electrically charge the air, killing microbes, COVID, and the like. And actually, we think that the buildings will actually be a healthier building as a result of this system. Even post-COVID, we think the air will actually be cleaner, providing a healthier work environment. Recently, we actually completed a lease negotiation where we agreed to turnkey the entire ionization system. So we're, as part of the actual construction of the new tenant space, we're actually providing this system for the tenant. Now we're also testing UV light systems that can be installed into light fixtures or in ductwork. This system that you're seeing in this photo is an actual photo of the New York City subway system testing UV lighting. UV technology has been around for decades, and it is a proven killer of microbes, including COVID. Another new technology we're looking into is dry hydrogen peroxide gas. Similar to the ion technology, it's a very low dose of hydrogen peroxide, which is suspended in the air, and it's very effective in killing microbes. Okay, so again, making buildings safe is the key. We don't know what the future demand is going to be for office space, but we know that by investing in new technology, we can make our buildings safer places to work. And by making our buildings better than our competition, like Lyndon mentioned before, we can actually grow our market share. Even as COVID-19 creates some temporary headwinds, we expect Florida and the Tampa Bay area to be a big beneficiary of headquarters relocations as companies in New York and other densely populated cities seek out markets that are less dependent on mass transit. With the passage of the 2017 tax cuts, the entire state of Florida is benefiting from an exodus of companies and residents from high tax states. Under the new tax law, state and local tax deductions have been severely limited by local and state governments in Florida, outside of the state of Florida. As a result, people in states with higher taxes are fleeing to Florida, where we have no state income tax. We lovingly refer to the 2017 Tax Act as the Florida Subsidy Act. Nearly 1,000 people a day are in-migrating currently into Florida, and Florida has recently surpassed New York as the #3 state in America for population. So we're the 3rd largest state now in America, having bypassed New York. We expect and have already seen evidence of national companies looking to relocate out of mass transit dependent cities like New York as a result of COVID. In fact, if you put your ear to the New York State border, you might hear a loud whooshing sound of people exiting for the state of Florida. In Tampa Bay, we like to joke that we have been planning for this epidemic for decades because we've steadfastly avoided mass transit. In addition to fears of mass transit, there will also be economic pressure on companies to reduce costs. We think that with softer economic conditions, it's possible that companies will seek out lower cost regions like the Tampa Bay area. So in our view, the outlook for high quality Tampa Bay office space is very strong. Coupled with the fact that we've collected over 95% of our rents, we are feeling cautiously optimistic about the future of Tampa Bay office space. So let's talk about Tampa Bay a little more specifically, and let's take a look at this map right here. The blue body of water in the middle is actually the bay we refer to as Tampa Bay. To the right of your screen, you see Tampa, which is why we obviously call it Tampa Bay, but Tampa is one of 3 cities. You'll see all the way to your left screen in the upper left-hand corner, Clearwater, and to the bottom of your screen, St. Petersburg. These 3 cities, Tampa, Clearwater, and St. Petersburg, make up the Tampa Bay area. And we are the #2 city in the state of Florida, second only to Miami. And depending on the month, by the way, Tampa actually outgrows Miami on certain months, and some months Miami adds more population and more jobs than we do. So it's kind of neck and neck. So let's talk about downtown St. Petersburg, where First Central Tower is actually located. St. Petersburg boasts a very walkable downtown with over a mile of waterfront and green space. Downtown St. Pete, as we affectionately refer to St. Petersburg, has the look and feel of an upscale European city along the Riviera. Traditionally, St. Pete has been known as a community for very wealthy Midwestern retirees. These wealthy retirees need financial, accounting, and legal experts to handle their estate planning. So in our building, we have many lawyers, many accountants, financial companies, investment banks that handle the estates for very wealthy Midwestern retirees. However, in recent years, according to the US Census, the city's average age has actually been dropping. This change tracks with the national urbanization trend as thousands of well-educated young professionals have flocked to live in downtown St. Pete. These millennials are attracted to the extensive art, cultural, and nightlife venues that St. Pete is known for. By the way, these millennials act like a magnet for companies to hire in the downtown St. Petersburg area. They love to hire these millennials because they're computer savvy, tech savvy, and they were born with computers. So they really have added productivity. In recent years, the St. Pete area has actually become a hub of arts and entertainment. It's home to 8 world-class museums and national events such as the Firestone Grand Prix. This is actually a Grand Prix event that takes place in the streets of St. Petersburg, similar to the European Grand Prix. The city was recognized as the #1 arts destination in the country by American Style magazine. This is the Salvador Dali Museum. By the way, this is the biggest art collection of Salvador Dali outside of Spain. Downtown St. Pete also boasts 2 professional sports teams. The Tampa Bay Rays, which is a Major League Baseball team, play at Tropicana Field, just a few blocks, about 10 blocks actually, from our First Central Tower. There are almost 100 restaurants located within a 12-block radius from First Central Tower. Many of these restaurants cater to the very affluent residents that live in the area. St. Pete offers a large complement of shops, nightlife, cultural arts, and fine hotels, all located within walking distance of our property. As one of St. Pete's few Class A office towers, First Central Tower is uniquely positioned to benefit from this thriving downtown location. Now let me, if you will, let me now transfer and go right into the specifics about First Central Tower. The photo that you see in front of you is the building. It's called First Central Tower. It's named after BB&T, which you see the logo at the bottom of the building. That bank is now been in the process of being renamed following a merger with SunTrust. First Central Tower is a trophy office building. It's a true trophy office building, given the quality of the building, the location, and the tenant roster, which is a highly diversified roster of national and local tenants. A key point to keep in mind is that buildings that have very large tenants that occupy, say, half a building are actually very dangerous things to own. For example, let's take a 200,000 square foot building that has only 2 tenants of, say, 100,000 square feet each. At lease expiration, if one of those 100,000 square foot tenants vacate, the landlord could actually be looking at a foreclosure at the time of the lease expiration of this 100,000 square foot tenant. In contrast, our average tenant does not occupy more than about 5–6% of the building. Our largest tenant is only about 13% of the building. And our tenants consist of very high credit, mostly banking and financial institutions and the like. And also, our average lease term has over 4 years remaining, so that gives us significant stability of cash flow. So we like to say that this investment is somewhat shelter in a storm. I don't want to say it's bulletproof, but I do feel like this is somewhat of a shelter in a storm. Now, that photo that you're seeing right now is the actual lobby photo. That's a real photo of the building. This is part of a $10 million renovation we did, by the way. That logo at the far end of that lobby, you see BB&T is now part of Truist Bank. Truist is a merger of BB&T and SunTrust that now form this large bank called Truist. The Truist lease runs to the end on December 31, 2025. Our next largest tenant, Regus, which is a London-based, publicly traded company. Both are, by the way, Truist and Regus are our 2 largest tenants. Both are multi-billion-dollar publicly traded companies. The Regus lease expires in 2027. So here are a few additional shots of the building that are some of my favorite shots. The one on the left-hand side shows you a very modern design of our elevator landings. This is as you come out on every floor. Then the shot on the right is actually a side view of our elevator bank on the main lobby of the building. Okay, so now let me just review some of the history of the capital improvements in the building and some of the things that we've done. If you can advance to the next slide, we're going to just look at the chart here. As you can see, we've invested over $10 million in capital. This was done in the last 2-3 years. And our investors will benefit enormously from these renovations. These renovations, just a few of the items that we've done, are a completely new lobby, a major upgrade and modernization of the entire elevator system, a new tenant conference center, a new roof, a brand new fitness center with all new high-end equipment, a 24/7 tenant chill zone, and state-of-the-art energy-efficient cooling and lighting systems. Incidentally, we completed these investments with our current capital partner who will be exiting on this transaction. They are a large private equity company called Grandview. Grandview will be exiting on this transaction. They are exiting because their fund has decided to devote themselves exclusively to industrial investments, so they're divesting of their office product. At this point, I'd like to turn over the webinar to Chris Ross, our VP of Finance, who will actually talk about the financial numbers on the deal itself for First Central Tower. Go ahead, Chris.
Thanks, Larry. Hello, everyone. My name is Chris Ross, and I am the VP of Finance for Feldman Equities. We approached the underwriting for First Central Tower with a conservative mindset. In light of all the uncertainty around COVID-19, we wanted to make sure this investment will continue to perform even if a substantial portion of our tenants stop paying rent. In order to be conservative, we're assuming a year 1 vacancy of 10%, year 2 vacancy of 11%, year 3 of 9%, year 4 of 8%, and year 5 of 6%. These numbers compare to our actual vacancy of 5% today and actual rent collections of 96% of all tenant rent for the months ending July 31st. You will see that we've underwritten a comfortable amount of reserves to cover future leasing costs and building capital needs. We see the offering price as a conservative valuation representing a 6.5% cap rate on the year 1 net operating income. This valuation also represents a 35% discount to replacement cost. As you go through the offering materials, you will see that recent Tampa and St. Pete Class A office buildings have traded in the 5.6 to 6.7% cap rate range. The offering price is at the high end of that cap rate range. We think this valuation is particularly attractive given that this is a 95% leased building with a relatively stable rollover schedule over the next 4 to 5 years. Following the closing, the sponsor will have a large amount of skin in the game with approximately $5.5 million of equity. Our year 1 net operating income of $4.6 million is forecast to increase to approximately $5.7 million by year 5. This is a 24% increase over the 5-year period. This growth is partly attributable to the fact that our average in-place lease rate is $27.94 per square foot, whereas the current average market rent for the building is $31.13 per square foot, or an 11.4% difference to bring current rents up to market. This represents an opportunity to raise rents as current leases expire over time. Recent downtown St. Petersburg vacancy rates have dropped from 5.9% in 2019 to 5.3% currently. This is one of the lowest vacancy rates in the Southeast U.S. In addition to the extremely low vacancy rates, there are no new office buildings under construction in the downtown St. Pete market, and we see this trend continuing for the next few years. We've been actively involved in prospective new office development in Tampa, and I can tell you that the cost to build a new Class A high-rise office building is approximately $450 per square foot. This compares very favorably to the First Central Tower offering price. If and when a new office building is delivered, it will need to have, at a minimum, rental rates in the low $50 per square foot to make the numbers work. By contrast, the average rents in place at First Central Tower are $27.94 per square foot, which represents a nearly 50% discount to the rental rate required for a prospective new office building. So with a low probability of new near-term office construction, we're feeling comfortable in our ability to continue to increase rents steadily over the next 3 to 5 years. The year 5 sale of the building assumes a 6.5% exit cap rate on the year 6 net operating income. This equates to an exit valuation of $371 per square foot. Again, this is well below the replacement cost of new Class A high-rise office space in today's dollars. Including extension options, the current loan on the property has 4 more years until maturity. As soon as market conditions permit, it's our intent to convert the debt to a long-term fixed-rate loan. We're using a portion of the proceeds from this equity raise to pay down $1.5 million of the current loan, making this a more conservatively leveraged property with a loan-to-value ratio in the mid-60s%. As you can see, we're forecasting an average cash-on-cash of 9.1% over the next 5 years. The year 1 cash-on-cash is forecast at 7.1%. We're assuming a 6.5% exit cap rate, which results in a 15% IRR to investors. We see our exit cap rate assumption as reasonable, given that the forecast sale price in 5 years will be well below today's replacement cost. Please let us know if you have any questions after you've had the chance to review the offering materials. At this point, I'll turn the discussions back over to Larry.
Thank you, Chris. So to summarize, we think that this investment in First Central Tower offers investors the best of both worlds. So what do I mean by the best of both worlds? Well, what I mean by that is that we have a very stable cash flow. Our average lease terms greater than 4 years remaining. We have a lot of credit backing up that cash flow in the sense that the tenants in place are strong credit. But also our leases in place are significantly below market. So we have growth potential as well over time. Now it won't happen overnight, that growth, but over time there will be what we refer to as a mark to market, in the sense that the below market leases, when they roll to market, will pick up in rental rate. So for all of those reasons, I feel that this investment is sort of great shelter in a storm, so to speak, thinking in terms of the COVID situation, a bit of a storm, but it also does provide some upside. So with that, I will turn it back to Lee and to Scott to deal with the Q&A, which we welcome, and other administrative matters. Go ahead, Lee.
Thanks very much, Larry and Chris. That was a great overview of who you are and the project itself. We look forward to engaging with you on this opportunity. I'm going to hand over to Scott. We have investors and attendees from all over the world. Some of them are new to our ecosystem. Some of them have been with us for a while. And Scott is going to run through actually doing an investment into your deal, as it has now, we are pleased to announce, gone live for funding on our platform. So Scott, if you want to take control of the screen and show everyone just how easy it is to partake in this opportunity.
Let's You should all be able to see my screen now. And just before we go there, you will basically see me logging in now. So this would be, you'd effectively go straight into the platform. So I'm showing you live now, and if I go in, I can have different entities. I'm just going to use my personal name for now. Now, I can look through the marketplace and I can look at the different deals that are here. Tonight, we're specifically talking about First Central Tower. So I'm going to go in. I can see all the different pictures. I can read about all the different overviews, market summary. I can read about Feldman Equities and the due diligence they do. In the top right corner, I can go and see all the different information. I can see the IRRs and the cash on cash returns. I can talk about the investment category, and I'd like Lyndon just to talk just a little bit about this, because this is really important between core, core plus, value add, etc., and really risk. You know, Larry, you've spoken a lot about shelter in a storm. And I think one of the things that we look for in these times of uncertainty is where people are wanting to protect their capital and also look for good predictable income. And Linda, just talk to us a little bit about the investment risk category, because risk is always important for people to understand.
Yeah, great. Thanks, Scott. And I think, you know, what's exciting is this is a very interesting deal to talk about in terms of the risk category. If you had been one of the initial investors, I think Larry has mentioned that they had a large institutional partner who took out a major piece of this deal. They would have invested probably at the value add stage of the business. That's where it's a building in a really good opportunist, in a good area, but it needed work. It needed to be upgraded. There was an opportunity, and I think as Larry mentioned, they spent quite a bit of money on upgrading it. That would be a value add risk. Your risk is quite high. You're going to have to put in a bit of capital. You have assumptions about once you have completed those renovations, whether you'll be able to match a leasing scenario as you're predicting. So because you have more assumptions in that business model, you have more risk, but the returns could potentially be higher. This building has gone through that phase. The renovations are complete. The tenant base has been stabilized. They have a very clear idea of what the capital expenditure looks like for the next 4 to 5 years of the deal's life. So from a risk perspective, your risk is less. You're now down at a core plus scenario. You've got a tenant base. It's a very diversified tenant base. Of those 47, most of them are significant companies, some global, with very good trusted tenant base. So that puts you in the core plus. Now, what would need it to be further on core? You know, if this building was in central New York, you wouldn't have a chance at it. Let's be honest. It would be, you know, the price you would have to pay for exactly the same returns would be significant. So your return would be less. That's one of the advantages of not always investing in central New York, for example, because your returns, that margin of being maybe outside of a New York and in somewhere like Tampa Bay, you get a bit more of the margin. But that's the core plus. A great building, you know what you're getting, tenanted. It might not be in central New York, but it's in a very good growing metropolitan area. So the last one I haven't spoken about is opportunistic, and this is where either you're developing from scratch or you're going to take an existing building and completely redo it, either from a business model perspective or even from your actual capital expenditure into the property. For that, you're going to have to spend a lot of money. There's not going to be income for probably the first year or two while you're doing those developments. You're betting on, by doing that, you're going to buy the building at low cost, you're going to spend money, and you're betting that when you're done in 2 years' time, you'll be able to get your returns through whatever changes you've made, increasing your rent roll. Your assumptions are more, your risk is higher, your returns will be higher. So to summarize, this deal has just come out of the value add phase. The value add investor is moving into industrial, and that creates an opportunity for people who are looking for a good opportunity in a, to use Larry's words, that ship in the storm, where it's a core plus. You get a much more stable opportunity, far more privileged.
I've lost you a bit there, didn't it? So what you can look at here, you've got all the different documentation, so you can go and read all the different case studies, lease comps, offering memorandum, and even the breakdown. I have pre-looked at it, and so you can go read all through it. Brilliant document, actually. Well done, well put together by your team, Larry. So really interesting.
Thank you, Scott.
Everything, and you know, look and feel and everything that everyone wants. in terms of what you're looking at. So, and then you can go down, you can read the risks and the projects, etc. What's important here, and just before I go to invest here, is I wanted to tell two quick stories. The first one was that I arrived in America in 2010 to buy property, just in the heart of the last crash. And believe it or not, where I started was Tampa. And it was really interesting because in those days, we could not find people we could trust. In fact, I went to Tampa and some guy put me in a car and drove me for 8 hours north of Tampa. I'm not joking, one day, to try to sell me a multifamily. And I sort of got the sense that he would sell his sister along with the property if he could just get rid of it. And what's so refreshing for me 10 years later is that we're dealing with partners like yourself, with a huge amount of track record. And I think what's also important here is what Lyndon said there. If I come back to this point here, where the value add and the private equity might be leaving, the core partner, which is Feldman Equities, is in the deal and is staying in the deal. They're not selling you something, they're staying as part of the deal, which is fantastic. The other story I wanted to tell you was my uncle is a very successful stockbroker, and he told me 20 years plus that you need to buy properties in the sun because everyone's going to move for lifestyle. And it's just interesting because Tampa and Florida and all the numbers you've said, Larry, are such an obvious, why live in New York anymore? And things like COVID are just going to accelerate that, where people actually realize they can have better lifestyle. So I've got 10 reasons why I wanted to invest in this. And I'm not going to lie, I put pressure on the team because I wanted to invest tonight while we were live on this launch. And there are 10 reasons if I give them to you quickly. The first one is Florida, and even more so Tampa. So again, we've invested all over America a lot, and two of the best states are Florida. We've, you've got Texas, you've got Atlanta. All of them have high growth areas. They've got low taxes, and Florida is one of the top in terms of the areas that we look at. The second one for me is trophy assets, and really all the institutional companies that are part of it. I really like your track record during COVID. A question I always like to ask people is, how did you do in the last crash? Well, that used to be 10 years ago. Now it was 4 months ago. But the point being is that during COVID, it's like, how has it fared? And 96% is really encouraging. The fourth thing for me is technology. You said that in times of downturn, you like to take market share. Well, in an old days, you'd go into a building and you'd renovate it and make the elevators look nice. Now you have all the new technology around making them, healthy, I suppose is the right way to describe it. And that will be a value add in terms of the Class A. St. Petersburg and downtown, I have to say, I agree with Lyndon. The next buyer's trip is definitely going there. It looks absolutely stunning. And, what you said about all the Midwestern wealthy people, a rising tide rises all boats. If you're in a wealthy area with wealthy suburban people around, that means you're going to have wealthy accountants, wealthy banks, wealthy investment bankers, family offices, etc. And they are going to be around, where those people are. The sixth reason for me is that I watched a movie recently, a true story of two African-American investors in Los Angeles, and they couldn't get proper mortgages. So they eventually decided to buy the bank building in central downtown Los Angeles, because their logic was, if they're the landlord of all the banks, then they'll be able to get the best access to the mortgages. And I just love the mentality of going and buying the biggest trophy asset in downtown Los Angeles. And First Central Tower, to me, looks at, even when you look at the landscape, looks very, very similar to that. So it's that classic trophy office building. You put $10 million of renovation in. The leases are 4 years plus. It's got banking and financial institutions. One of the things I liked here is that you mentioned highly diversified, and in your brochure, you actually said there's 47 different tenants. It's so interesting. People don't fully understand what you're saying if you've got one or two tenants. I always laugh. I did 9 years in London, and when Lehman Brothers went bankrupt, the developer owned the entire Tower 42 in central London. And they thought they were absolutely bulletproof. I mean, they had Lehman Brothers as their tenant, and guess who their insurance partner was? AIG. And I guarantee you for a few weeks, that developer was a little bit worried. And so I'd far rather have 47 people paying my rent. And that's why it's a great shelter in a storm. And as you said,
excellent point. Excellent point, Scott.
Publicly listed tenants. And then my last two things, which I think is important, is that, Lyndon, you mentioned that Grandview, the private equity partner, is leaving and moving. The one thing that I've learned is that when you're dealing with private equity firms and mandates change, that just means that they make decisions across the board, across all markets and everything else. And that means you can actually generally pick up very good assets when those sort of mandates change. And, they often say in property, one of the best ways to invest is from a motivated seller. And what I'm picking up here is that the price is $3.5 million down on pre-COVID, which actually means that people are picking up a discount as well. The replacement cost, I think Chris summed that up, and I don't know if people actually heard those numbers, but to rebuild this building would cost $450 per square foot, and we're buying it for $289 a square foot. So, that replacement cost is such a critical component when you're investing, because if you're buying below what someone else has to build it for, you're always setting yourself up for success long term. And that's equally with the rents. I loved what you said, where the average rent would need to be around $50 and your average rent was $27, which is roughly 50%. And then the last one, and I don't know how else to say this in a nice way, but it tickles my ego, because I've had the privilege of investing in a number of commercial buildings, but I've never had the ability to invest in a building that looks quite like this. And so for me, we can talk about cash flow, we can talk about IRRs, we can talk about whatever you like, but on the basis of ego, I want to be able to say that I'm an investor in this building. So really what we would do is we would literally go in and, why did it kick me out? It's because I was doing too much talking. Lyndon's created a system that if I talk too much, it switches me off. So basically, if I log in here and I go into the deal, I've now decided I want to participate in the deal. I'm going to do $1,000. I don't know, Larry, if you know, but we have once a month on a Wednesday where we actually, around the world, we drop it down to $1,000 to really allow pretty much anyone in the world to be able to participate. And I go in, I can literally acknowledge all the different terms and conditions. I obviously will go in and read the investment application and conversion documents, and I can literally go and agree. Because I've pre-funded my wallet, I can now go and make my investment. And what you basically just witnessed in less than 30 seconds is me owning an American building in America in 30 seconds. Now, why that's really important is because when I bought my first properties in America, I had to fly to America, I had to set up an LLC, I had to open a bank account, I had to go and find partners on the ground. And what you've just witnessed is that, Larry and Chris have shared with you an amazing opportunity. One of the things I didn't mention, which I also liked, is that in terms of the partner, you've got the largest private owning in the entire area. That for me is something that is so important. I always say that when I invest, I don't want to invest just in property, I invest with the partner. And here you've got a partner like Feldman. They've just raised $20 million from Americans in America through CrowdStreet. And now all of us outside of America have the opportunity to participate. And so I just wanted to say to you, Larry, that in 30 seconds, I've become your partner and invested in your deal alongside you. And hopefully, Lee, back to you. It's now up to everyone else to be able to participate from around the globe.
Thanks very much, Scott. Lee, do you want to open it up to Q&A at this point?
Yeah, absolutely. Thanks, Scott, for running us through the investments and the different parts of the deal. So we've got quite a few questions that have come in, so I'm just going to start firing them off, and whoever in the panelists is best to answer, please just chime in. I think the first couple are definitely straight for the Feldman team. What do you like about bringing foreign investors into your assets for the first time, and why now?
Good question, Lee. My father, who preceded me in the business, used to say that real estate development is similar to manufacturing. The only difference is in a manufacturing plant, when the tractor trailers come in, these are the big trucks that come in to the side of the manufacturing plant. The difference in our business is that those trucks need to be filled with cash. This is a very, in other words, this is a very capital intensive business. What happens historically is we have done and continue to do partnerships with large institutional investors. So right now, one of our large investors is New York Life Insurance Company. We have done deals with companies like Goldman Sachs and Dreyfus Realty Advisors and other big institutional companies. But these monies run hot and cold, like you mentioned before, Scott. It's not always a reliable spigot of money. You also have the vagaries of the U.S. economy. At times, the U.S. economy could be somewhat down, but foreign markets might be much stronger. So we love the idea of having a diversified roster of investors, both in the US and outside of the US, to deal with the different cycles. Because when things are down, and unfortunately I've lived through at least 3 cycles, you want to be opportunistic and buy aggressively when things are down, and you want to have ready cash to do that. So we love the idea of opening up this investment to the international investors.
Great. Thanks, Larry. Can you talk about Feldman Equities' presence in the Tampa Bay market?
Sure. Like Scott mentioned, we are the largest privately held owner and developer of office buildings in the Tampa Bay market. In downtown St. Petersburg, which is part of Tampa Bay, we own 3 out of the 4 major buildings in downtown St. Petersburg. So why is that important? When a prospective tenant comes to market, and let's say they haven't looked at St. Petersburg before, we will get a look at that tenant almost without question. Every tenant effectively coming in to the market will come see us. We spend hundreds of thousands of dollars a year in marketing to the real estate brokerage community. In fact, it's almost like we have 150 loyal captive salesmen, but we pay, and what we do is we pay them more than our competitors, and we pay them faster. So we're a very strong sort of local sharpshooter in our market. We wouldn't be very good in places like San Francisco or New York, but in Tampa Bay, we are a dominant player.
Great. You and Chris spoke a lot about replacement costs. Can you talk more about why that's important to the valuation of this opportunity?
Yeah, Scott, thank you for mentioning that earlier. Replacement cost for this building is somewhere between $450 and even $500 per square foot. And that's if you could find the land. This building is right near the waterfront, although we're not at risk of global warming in our location. We're very close to the waterfront. We have beautiful views of bridges and yacht clubs and so on. That kind of land is almost non-existent. So even if you could buy the land, you're talking about $450 to $500 per square foot. The local municipality is very tough on giving building permits and entitlements. So the barrier to entry is very high. We think that it's at least from where we are sitting today, probably 4 to 5 years before we will see a major office building come up in the downtown St. Petersburg market. And if it does, as Chris pointed out earlier, rents need to be $50 to $55 per square foot. So if that happens, Lee, we should all go out and get drunk, because it means our revenue is up probably 40, 50, 60, 70%.
Well, that sounds fabulous. We will hold you to that drink when we all come on our visit and come and view the property firsthand.
Good.
So on everyone's minds at the moment is this going to be another downturn like 2008 was? So what is your contingency plan if the current economic climate turns out to be a downturn?
Sure. We have actually done more than survive. We have actually thrived at times. Not to say that we've thrived financially in the worst of times, but we've grown our portfolio in the worst of times. And then as a result of growing our portfolio, we've reaped the rewards down the road. What we do in every downturn is we get very aggressive on the leasing side. So we typically will never wait for the higher rental rate and sit with vacant space. We go after the strong credit tenants. So a big national investment bank right now has a lease in negotiation with us right now. We're giving them a little more free rent than we ordinarily would, where the free rent period bridges them through the COVID period. But the credit of the tenant is fantastic. It's a 7-year lease term. So while there is a period of 6 or 8 months of free rent as an inducement to come in now, as opposed to waiting till COVID is over, we are getting back a long-term lease from a credit tenant. Those are the strategies we've employed in the past, and we will do whatever it takes to get a tenant. My dad used to refer to this strategy as rent and repent, meaning don't hang out, don't wait for the highest price per square foot. Take the market as it is and undercut and take, if the market share goes down, we're going to take a bigger part of it. And then, as we mentioned earlier, COVID technology and making our buildings much safer, and specifically what we're doing here with respect to First Central Tower. As part of the raise, we have raised $400,000 to employ for COVID technology. So we'll be actually putting in these ionization systems throughout the building and utilizing the raised money to do the next phase of renovation. So we've done, and Lyndon, you did a great job in describing the fact that we've done the sort of heavy lifting of the 10 million renovation. That's all in place now. The COVID technology is what will get us through the current situation. And then the beauty of that COVID technology, incidentally, which I love, and this was really a side dividend, is that ionization cleanses the air and makes the building a healthier building down the road. So even long after COVID is over with, people who are reporting, for example, our chief engineer actually put this system in his house. He and his wife are long-term allergy sufferers. They're reporting that the allergies have disappeared in their house since the system has been installed. The air actually smells cleaner, like it does after a thunderstorm. So that we also think will help make our buildings safer and help us capture market share.
Sort of answers Andelia's question, Lee.
Yeah, absolutely. I'll go back to that in a second. So you've spoken about the needs for COVID and what you are doing around making your buildings more COVID efficient. Are there any other capital needs that you have for the next few years?
Really, there is nothing more to be done. Of course, in owning a building, there is always the unforeseen, but most of the things that can go wrong, like the roof has been completely replaced, the air conditioning systems have been completely replaced, the elevator system has been completely replaced, not just the pretty elevator cab that you get into, but the entire mechanical system. That was about a $1.6 million renovation. So we don't foresee any other needs for capital improvements other than the significant investment of some $400,000. We're not sure about that number yet. We're still honing in on it, but we'll be spending a significant chunk of that $400,000 for COVID technology and probably keeping a reserve rainy day fund just in case. We also reserve cash flows for reserves for future capital improvements because you never know what can happen.
Absolutely. And have you conducted or are you going to be conducting a cost segregation study on this property?
Yeah, very good question. For those who don't know what a cost segregation study, this is now the arcane world of US tax law. It's very interesting that the tax laws became even more favorable to real estate people when a certain president became, certain real estate developer became a president in the United States. Those laws allow a developer to depreciate a building faster by segregating certain components of the building through an engineering study. So we bring in an engineer who places a value on each system. So for example, those elevator systems that I mentioned that we recently replaced will be segregated as a separate bucket, and we will be allowed under the new tax law to more quickly depreciate that elevator system. And that was what we mean by cost segregation. We're segregating the cost of the elevator apart from, say, the concrete floors which maybe have a 39-year depreciation schedule. The elevators may have a 5 or 10-year schedule. So by writing off the building through the tax law, we can provide quite a bit of shelter to our investors. Now, I will caution everybody, please talk to your own tax advisors. Everybody's tax situation is different. So I'm only going by US tax law and my own knowledge of the law. But we think a significant portion of the going in yield, which is over 7% on this deal, will be sheltered from taxes, at least until a sale. Now, ultimately, when there's a sale and hopefully there's lots of cash, you will have to pay back those taxes. So bear that in mind as well.
Thank you. So following on from everything that you've done to ensure that your building has the latest COVID technology, are you doing any renovations or plans to accommodate any laws regarding social distancing, people returning to work, the maximum capacities, etc.?
Yes, that's sort of in that low tech area that I mentioned. We're restricting elevator use to 2 people per elevator. By the way, in case you didn't know this, you're not supposed to talk in an elevator, because as you talk, you spew out microbes. And so we put up signs in our elevators: don't talk, wear a mask. I've been thinking about instituting that in my kitchen, by the way, with my wife in the morning before my coffee. She doesn't like that joke. Anyhow, yeah, those sort of low-tech things we're doing to encourage social distancing. But what we're actually doing in terms of layouts of spaces. So when a tenant signs a 7 or 10-year lease, we will build out a space for them. We'll work with their architect on how best to lay out the space. While there are no new laws yet on the books that are mandating and forcing you to do social distancing, employees will want to do a lot of social distancing, which as a developer is a wonderful thing, because that means more space per capita, offsetting the percentage of, say, 10 or 20% that may work from home or may at least part-time work from home. So the design of those spaces, we'll be working with architects and with the tenants' facilities personnel to design the layouts to make it more hospitable for social distancing. Does that answer your question, Lee?
That absolutely does. Thank you very much.
Good.
With you saying that you take advantage of the downturn in the market, how often do you envisage that Feldman is going to bring out new investment opportunities of this nature?
We are targeting about 4 deals a year right now. That's what we can comfortably do without getting into an overwhelm of our system. So that's about the pace that we're projecting. Now that can vary. We're hoping there will be some opportunities on COVID. Interestingly, in case you think the US is on a fire sale for real estate, it's not true right now. The housing market is actually rising right now in pricing, and the office building market has maybe eased a little bit, maybe just hasn't gone up anymore, because what's happening to counterbalance the COVID situation is an enormous discount on interest rates. So I had a housing developer who's a buddy of mine tell me, you know, Larry, there was a headline I was looking on my iPhone that said 25 million people have been unemployed in the United States. And then the next headline, an hour later, was the 30-year fixed rate mortgage on homes is now the lowest in the history of the United States. At the beginning of the month in May, this was in May, he was relating this to me, the real estate, his projection for sales of new homes actually was way down, about 20% of his target. By the end of May, he was at his full quota and projection for what he anticipated selling in the way of new homes by May. And then in June, it got better. So that's the housing market. On the office building side, on this particular deal, as a case in point, there is a fire sale benefit that we're getting due to COVID, which is that the interest rate on our debt is floating down. It's a floating rate debt which is floating down, which, by the way, we're in the process of locking for 10 years. But as a result of COVID, it has come down to 3.6%. So when you have a 3.6% interest rate on debt, it's unlikely we're going to see huge rises in cap rates, which, for those who are not, real estate wired for terminology, cap rates are the yields on it going in investment. And typically in bad times, the yields go up, meaning the prices go down, like bonds. But right now at 3.6%, we don't anticipate a big drop in pricing, and we think pricing on office buildings are going to hang in there. Nevertheless, if we can buy them below replacement cost in the Tampa Bay market, we're going to keep buying them. And as I said, we're going to target to do one every 3 or 4 months right now. That's obviously going to be a highly variable depending upon seller appetite.
Is Tampa Bay a hurricane or tropical storm danger zone? And if so, what happens to our investments?
Well, I spend 90% of my year in Tampa Bay, but I still have a home on Long Island, which just got clobbered. I'm actually doing this webinar from my buddy who is an equine veterinarian. In case you don't know what that means, it's a horse vet. And we just got clobbered by a hurricane that missed Florida and hit New York. It was like a complete destruction of the trees out here. So anyhow, the thing about Tampa is we rarely, I don't, and I'm going to knock on some very large wood in my office here, my buddy's veterinarian office, actually. The way the geography works in Tampa is we have rarely, the last real major hit was in the 1800s. It doesn't say we can't get hit, but what happens is the geography of storms is that when they round Miami, they either go west into the Gulf of Mexico and shoot up into the panhandle of Florida, or points all the way to Texas. They really, it would take that kind of a thing, and then it would have to come in at a right angle to hit Tampa. So it hasn't happened really as a direct hit in over 100 years. We've had some glancing blows. We thought, a couple of years ago we'd have one. One of the strategies we're employing is that all of our buildings, although they are near waterfront, we are not buying right on the waterfront. So our buildings are set back so that we're at a sufficient elevation that we are equipped. We're set up to prevent flooding. Now we also insure our buildings for full replacement cost, for full hurricane insurance. We have a large deductible, but we can handle that if we had to. We're really concerned about the catastrophic loss.
Great, thank you. I'm just scanning through some of our questions. Lyndon, I see that there are quite a few questions that have come up to us, particularly specifics about the deal and also minimum investment amounts, all of that. I wonder if you just want to run through those and answer those for our attendees.
Yeah, surely. I think the one I'm going to start with, which has come up 3 times in the question box, is why do the deal financials differ on our platform versus the information both on our platform if you read the brochures, but also through what Larry and Chris have taken us through? And that's a great question. You'll note on all our US deals, the offerings, the returns we have on the platform are lower than the offerings that are being put in the brochure. The reason for this is that the offerings, the returns you are seeing in Larry's documentation and from Chris's presentation are the returns paid to the US investor. Now, as an offshore investor, Wealth Migrate aggregates all our investors offshore. That's one of the services we provide, is that we do not require that all investors have to have their own US structures, LLCs, auditors, accountants, lawyers. We provide that service. But we have to pay US-based withholding tax when we take the money back from the US and take it back to the offshore investor. And that's the difference you're seeing. That is the impact of US-based withholding tax that will then reduce the amount. Now, we have a team of auditors and tax specialists on both sides of the ocean, on all sides of the ocean. They're spread between 4 different countries that we are continuously working with. We do have a pretty reliable model as to how we structure the agreement to minimize the degree of US withholding tax that we have to pay before we can remove funds out of the US and distribute to our investors. We spend a lot of time and energy on that. It's one of our, we consider one of our intellectual capital is that we have spent a lot of time structuring how we get non-US investors into USA deals to minimize tax. But that is the difference between the numbers you see there. So the numbers you see on our platform is what the investor actually gets returned to them after USA tax has already been paid. So that's the first one that applies to both the IRR and the cash on cash. Scott, I see you want to add something there?
No, I'm just going to say it's really important. You know, we feel very strongly that we want to tell you what you're going to get in your bank account, so that you literally can see what it is. And, you know, it's a great explanation on what Lyndon's saying. I mean, we could tell you it was 20%, but you'd be hell of a irritated if only 8.8 turned up.
Yep, and you know, I think just it's worth noting that there are at the moment pretty favorable tax regimes in the US for commercial real estate. I think Larry mentioned that. That can change. So these are our projected returns based on the best information we have at any one point in time, and if that changes, we are subject to USA tax policy, and we have to make sure we are fully compliant across all our operations. Lee, in terms of minimum investment rate at the moment, we have, as Scott said, today is WealthE Wednesday, the first Wednesday of the month. It has been dropped down. We will be raising it again, probably not tomorrow, because, you know, this particular new sponsor webinar was on the same day. We'll probably give those who have some dividends in their system that they want to quickly invest an opportunity to do that, but it will go back up to the normal rate of $5,000. I think I'll have to double check that. I think it was 5,000 or 10,000 in this particular deal. Part of the reason for that is because we're expecting this deal to go very quickly. Larry and Chris, I'm not sure for all our viewers, I think you might have been told about this as part of the invitation to this particular webinar. They went onto CrowdStreet, a USA-based crowdfunding platform, and I think, Larry, it was a record raise even for CrowdStreet. It was something like $20 million for this deal, was raised in something like 24 hours. So we are very conscious that this deal, the amount of equity in this deal is going very fast. We are wanting to really encourage investors who want to be a part of it to get in there, so that we can make sure that if there is any headroom, that we are a part of that as soon as possible. There was another, I think that's it, Lee. Were there any others that you wanted to direct my way?
Can American citizens participate in this deal through WealthE Migrate? Unfortunately
not. I think for most of you, USA citizens are not able to use the WealthE Migrate platform at all. This is standard. This is a compliance issue within the USA. One of the mechanisms that we use that enable global investors to get into the USA is something called the Reg Exemption. It's a very technical piece. You don't need to know about it. The bottom line is the American government is very willing to have foreign investors' money, as long as there is a strong segregation between those foreign investors and any USA investor. So we are not legally allowed to allow USA investors to use our platform.
And is this investment a REIT or a single building?
This is a single building. Go ahead. Go ahead, Linda.
Yeah, this is a direct investment, equity investment into a single building offered by a direct sponsor.
There's one other here about preferred equity. Is there a preferred equity deal in this investment?
No, it's just all there is a mortgage, which is about 66% of the total value. The balance is all straight equity. Everybody is 100% aligned. The sponsor has 5.5 million out of a total of 27.5 million. We are pari passu with all the investors. Nobody has any preferred position whatsoever.
No, it's really interesting you say that. We're in another deal in Texas. I'm an investor in the deal as well. And when the proverbial you-know-what hit the fan, and suddenly there were preferred equity positions and everything else, and certain people were getting paid ahead of other people. So whoever's asking that question, because it's come from anonymous, I guarantee you is in the same deal as us in there. It is an investor with me in that deal. And so, it's a good question to ask, and I think well answered as well. That we're all aligned, we're all tied to the same ship.
Correct.
Lee, let me just quickly jump. I see Mark has come back saying, sorry, I missed the answer if there was one. I think, Mark, you took a cup of coffee 5 minutes ago. Yes, the difference between 11.6 and 15 on the IRR is because the 11.6 reflects what you will get as an international investor after US withholding tax has been paid, whereas the 15% in the US sponsors brochure is normally what they pay before the US investor has to pay their own tax on it. As offshore investors, we have to pay withholding tax before we can distribute money. That's the difference between the two. There's a question here that's interesting, and Zachariah, appreciate it. I'm not quite sure how to answer this question because I'm assuming it might have a different understanding. You might be asking it in a different way. Is this an ethical investment? I certainly believe so. You're investing directly with a sponsor as a shareholder in a office building, and that office building is being leased out and rented to tenants. It's a very straightforward, very transparent. There are no middlemen. It's who you see on this webinar today are the people running this particular deal. And so my take on that is absolutely it's an ethical investment. I'm not sure if there's a definition of ethical that you use that would differ to how I've described it, but I would certainly believe this is very much an ethical investment. Lee, back to you.
Thanks, Lyndon. I've got a question here. Can SA investors have their matured investment paid out to the USA to a USA bank? So when you sign up onto the platform and you create your profile, you are going to enter your bank details and all your other KYC documentation. What happens with our platform is when you invest, all dividends that come in from an investment go into your transactional wallet back onto the platform, and you can use that to redeploy into other deals, or you can choose to have it withdrawn out into your bank account. The bank account that is listed on your profile and that has been KYC'd by Lemonway being in your name or the entity that invests its name is where those dividends will end up. So you are, as a South African, allowed to have international bank accounts. If you are lucky enough to be a South African investor living in South Africa with a US bank account, we all want to know how you did it. But you are welcome to upload those details onto the platform and have your dividends paid out into that.
Lee, I flew to America on a Wealth Migrate buying trip and I set up my bank account. That's how I did it.
There we go.
Maybe, Lee, I could just catch, because there might be an unasked question in there around if that happens, do you still pay USA withholding tax? The answer is yes. You might have a USA bank account, but if you are a USA taxpayer, then you are defined as a USA investor, and we cannot allow you to invest through our platform. That's a very strict rule. If you have merely got a bank account in the USA or any other bank account that's in US dollars and you're wanting funds returned to that US dollar account, that is no problem. You will still be treated like the rest of our investors as non-USA investors.
And I know that, Lyndon, you're working with a broker dealer to find a solution for Americans, but anyway.
Yes, Scott, there might be a USA platform in the future. Let's just put it like that. But for now, we are a non-USA platform, and let's not put too much pressure on our new business development team just yet.
So there's one question here, and I don't know if you want to answer this, Larry. Someone asked up above here, and it was anonymous. I don't know who the person's name was, but they said, why if you've been using, going after Americans, why you did answer the question why you wanted to go internationally, but the question was actually more specific. They said, why were you looking to wealth migrate? And I don't know if you want to answer that, or I can even give it a shot. You're
muted, Larry.
Just while Larry's taking.
I wanted to make sure the horses in the background weren't making noise. Sorry about that. So with respect to our private placement memorandum and our legal structure, we are prohibited from taking in foreign investors legally. So Wealth Migrate is effectively, as far as we're concerned, a US-based company from a legal perspective, and you all are able to handle all of the legal issues that we would otherwise be prohibited from dealing with as a US private placement legal structure. That's my understanding from my attorneys. I don't know if you understand it any differently, but that's my understanding.
I think that's exactly right, Larry. And I think to answer that question for anyone on the call is that it actually works both ways. So not only does it solve your problem, but also for investors. I've personally helped about 400 people buy houses in America, and they had to set up LLCs and bank accounts, and you got the Patriots Act, you actually have to fly to America to open a bank account, and it's an absolute nightmare. We've taken all of that complexity out of it. So, I mean, everyone watched me do it in 30 seconds. And so not only does Feldman Equities get one check from an American entity, which is what they want, but all the investors can participate with all the hassle, without all the hassle. And that's really the value add that we offer, not only to Feldman Equities, but to international investors. And that's really the business model we have. So we're really excited by the partnership with yourself, and particularly where you already understand the likes of CrowdStreet and where the whole digital investment space is going, with your track record. I think it's a really exciting synergy.
Thank you.
Lee, I think that's probably everything, huh?
Yeah, in one way or another, we have covered all the questions. They've come through in different forms, but we have covered all the questions. Jay has asked if Wealth Migrate has a second favored US state to invest in. So Jay, I'm going to answer it in this way, and then if Lyndon or Scott wants to add to you, we actually do not choose the states. We choose the sponsors that we would like to work with, and that they bring great opportunities that could benefit our investors. And then it is up to our investors on the marketplace to actually decide whether there is appetite for the investment, whether they believe in the sponsor and the deal that they have brought. So it is not necessarily state specific, and we don't go out and target specifics at the moment. I hope that has answered your question. Is there anything you want to add to that, Lyndon or Scott?
Yeah, look, to some extent, I wrote the book on this, and with the whole idea around the GIDS thing, which is the Global Investment Due Diligence System, there is a higher level that you do look at with macroeconomics, where you look at the country first, and then you look at the states and the cities. I've had the privilege of probably visiting almost more American cities than most Americans, and that's not being arrogant. Trust me, most Americans on the East Coast haven't been to the West Coast, and vice versa. But Lee, we've traveled extensively, and Florida, Atlanta, Georgia, Texas, as an example, all three of those areas have high population growth. So that means a lot of people are moving into those states. There's a lot of work opportunities, and all of those are very positive things if you want long-term growth. I joke about this, but you can literally go to Detroit right now, and I can, even 5 years ago, 7, 8 years ago, I could sell you something at a 50% discount, but it's not a discount if it's never going to recover. 25% of Detroit is still sitting empty. And so it is very important to be in markets and states that are proactively going in the right direction from a tax perspective, from a population perspective, a lifestyle, affordability. I won't go into all the details. And you're exactly right, Lee. I want to be clear. you know, if Larry came to me and said, Scott, we're going to Detroit right now, and he had 10 reasons as to why he was going to Detroit, we wouldn't be arrogant to say no, because we'd like to really understand. But there is a macroeconomics that you look at in terms of the different areas that you want to go to. And for investors, you know, most investors on this call won't know this, but there's 300 MSAs in America. And an MSA is a metropolitan statistical area. You know, the chances of a foreigner coming to America and trying to figure out which state, which city, which sector, and which partner to find to invest is virtually impossible. Trust me, I did it for a decade. And that's why it's much better to go and find partners like Larry and his team that are on the ground. They understand the markets, they understand why those markets, and that's to your point, Lee, of what we primarily look for.
Thanks, Scott. Larry, another question has come through stating that they see from the information you acquired the building in 2014 and you've doubled the value since acquisition. So where does that place the current offer for our investors?
You know, investors have to look at what the value is today versus, number one, what are the available buildings for sale, if any, of which there are none in the market. Then they have to look at it against replacement cost. We still see this as a great buying opportunity. That's why we're putting in $5.5 million of our own money into the deal. We still think there's meat on the bone. You know, if you bought Apple stock when it was trading for $50 a share, and now it's trading at, this is not even because it's trading so much, such a crazy multiple, but you know, let's say you bought Apple even a year and a half ago for $200 a share, and now it's trading at 400, you would say, well, there's no more opportunity in Apple. I think there's even more, this example is an even better example in the sense that we're still trading at below replacement cost. So you can't buy iPhones at below their iPhone cost. You can't buy an iPhone at a discount of the cost of building an iPhone, whereas you can still in Tampa Bay. We in Tampa really have been in about a 8, 9, 10-year recovery from the 2008-2009 recession, believe it or not, where our pricing and valuations have just now begun to approach back to 2006 levels. We are not like New York or LA or San Francisco, where valuations have actually gone up way above their 06 levels. We're still at levels that are still very attractive in Florida. And that was because the market got hit much harder in Florida and has been slower to build. A lot of new construction has held off. In fact, there is no new speculative construction at all in downtown St. Petersburg. There is some in Tampa beginning, but it's fairly modest in terms of its overall supply relative to the total inventory. So for those reasons, I think it's still an attractively priced deal. We still see a lot of meat on the bone, so to speak.
I think also, Lee, don't take into account that, you know, there was $10 million invested in private capital to renovate the building as well, which won't have been taken into account in that.
Thank you, Scott. Very good point. Thank you.
And I think our final question, we do not give tax advice. So Mark, you're asking this. We're going to just tell you what we sort of understand about USA withholding tax, but we do strongly suggest that you consult a tax practitioner and get proper advice on how you can structure it to be tax efficient. So Lyndon, this is completely over to you. As non-US citizens, can we claim back the US withholding tax in any way?
So Lee, the easy answer to that is it depends. So it depends on many things, and I'm afraid there is no one central answer to that question. In the majority of cases, the answer to that question is no, and that's part of the structuring arrangement. I see that question came from Mark. So Mark, if you'd like to reach out to me directly or to Alex or Fritz, I'm sure they would be happy to also provide support and explore this further with you directly.
The other thing I just want to say to Larry's comment, you know, I've always felt very strongly that if locals are investing alongside you, that's a very important part. You know, if you were investing in Brazil and no Brazilians were investing, but they suddenly wanted you to invest at X price, you know, that would be a problem. And, you know, what Lyndon and Larry have spoken about is that through CrowdStreet, which are all sophisticated investors, by the way, they're not retail investors, they're accredited sophisticated investors, invested $20 million in 2 weeks based on these market caps, market valuations, and the story. That for foreign investors should be very important to take into account, because it's not like we're a bunch of idiots overseas that are expected to do this. Local Americans have done the same thing, and we're investing alongside them.
I'm very conscious of our time, Lee, so I'm going to deal with two very quickly, if I may. Anonymous, will there be articles to read on some of the topic, like the non-US investors investing in USA? We do have reference material on that, Anonymous. I can't send you an email because you are anonymous, but if you reach out to myself, Lee, Alex, or Fritz, we will certainly make available information to you, not a problem. Zachariah, thank you. I understand the qualification. Does it avoid interest? Yes, this is not a debt deal. You are not lending money. You are a shareholder directly in the opportunity. The income is generated from rentals, not from interest, and the return to you is paid as dividends, not as interest. So the answer to your question is yes, it is not a debt deal.
Great.
Brett's got a question. Brett's got a question, but Larry's already answered it, but I'm just going to repeat it again. Brett's asking, why come to South African investors when all the monies can be got from US investors? In simple perspective, Wealth Migrate has members now in 152 countries. So with you know, Feldman Equities, they're not just looking to South Africa, but to the globe. And secondly, you know, I think Larry already answered this, but any wise investment company will now realize that the world is their oyster. You know, 10 years ago, you know, you primarily would have got money from your local, you know, partners and stuff in Tampa, and maybe institutional cash from New York. Now they're starting to be able to go to the wider market in America. And what investment houses are starting to realize is that actually there's a lot of sense in going globally, because then, as Larry's already mentioned, you're not riding the rise and falls of local markets, because there's always different swings in markets. And really the most important thing that Larry and Chris and the team have started tonight is that really what you're doing is building relationships. You're building relationships and building a digital track record with global investors. And that has a huge value add to their business. Not today, you know, quite frankly, to them, probably the last hour and a half, they could raise a lot more capital from Americans in America quickly. But I'd like to believe that, as from the conversations we've had, they're in this for the long game as well. And the long game means you build a digital global track record, which will make them a lot more powerful and susceptible to market swings wherever they are in the world. Larry, I don't want to put words in your mouth, but that's what I've experienced from anyone in the world, why they're not interested in just targeting their local markets.
It's perfectly well said. I couldn't have said it better. So thank you.
Perfect. Perfect.
Lee, you need to.
Sorry, I have to do it at least once every webinar, guys. It's my trademark. So I'm just running through here, and it looks like we have answered all the questions.
Yeah, the dividends will be paid quarterly. So it will be basically from time of closing, you can work on the quarterly dividends in terms of payments.
So that is it from our side. Thank you very much to the team that has joined us, from Feldman to Larry and to Chris, for your presentation and staying online to answer our questions. We really do appreciate it. We are excited to be partnering with you. And do you have any last comments or anything you'd like to share with our attendees before we say goodnight?
I really appreciate everybody's attendance. We're available to answer any questions. We pride ourselves on a 24-hour rule that we try never to let 24 hours go by without a question being answered. So please feel free to reach out to us either through Wealth Migrate or directly to our website at ir@feldmanequities.com.
Thank you. Scott and Lyndon, any closing comments for this evening?
No, from my side, I really appreciate we've been on for minutes, which means that our investors, we've noticed attendees haven't dropped. So for 40 minutes, there's really been interest. To Larry and Chris, I really appreciate your time tonight. Thank you for joining us. Looking forward to this partnership with our investor base.
Great. Thank you very much.
Equally from my side, really appreciate everyone's time, including all the attendees and this exciting occasion. You know, may it be one of many more, Larry and the team. You know, we look forward to a long-term partnership, and I'm glad that I've invested, and I invite everyone else to join me.
Look forward to it. Thank you very much.
Thanks everyone, and to our attendees, thank you for spending the last hour and 40 minutes with us. We really enjoyed spending the time with you. Wherever you are in the world, we hope that you are safe, that you are healthy. Stay blessed. Take care, everybody. Bye-bye.
Thank you, everyone.